Because Walmart is the nation's largest retailer, they have a unique view into the consumer and how their spending habits are changing based on the economy. And Walmart just issued their latest earnings report. And while the news medias all gave it positive headlines, some of the things that I saw were dire warnings and things that caused me concern. So we need to look under the hood. I want to take you into an article by CNBC. Again, the headline is rosy. Walmart beats estimates, raises outlook, and it sees stable consumer health. Sounds great. What's to worry about, right? Well, let's dig in. In an interview with CNBC, Chief Financial Officer John David Rainey said that the company's brighter outlook reflects strength in the first half of the year. But he said Walmart decided against raising expectations for the back half of the year, especially since of the elections, the conflict in the Middle East, and other dynamics might influence the consumer sentiment. That might be true, but you know what? If they really saw that the consumer was spending more, I think they'd be raising their outlook, and they do that because they're hoping their stock prices goes up. And he goes on to say, the chief financial officer, in this environment, it's responsible or prudent to be a little more guarded with the outlook, but we're not projecting a recession, he goes on to say. Well, maybe. Let's go on and see what else. The next paragraph basically says what I said at the open, that Walmart is uniquely qualified to see what's happening with the consumer. But here, the company's reputation for value has boosted sales over the last 2 years as inflation drove more higher income shopper to its stores and websites. So we're going to see this, that people are trading down. And that's not a good thing, right? When people feel confident about their jobs, when they feel confident about their salary prospects and the ability to get a raise and the ability to make more next year than they did in the year before, including inflation, we need to beat inflation. When people feel positive about that, they don't trade down. Most people trade up. Now, I think it's important that we all save money, so we want to guard against lifestyle creep. But in general, the consumer continues to trade down. And then he says, along with inflation-wary shoppers, Walmart has made its own moves to drive growth. It looked outside of traditional retail channels as it sought to third-party marketplaces, sell more advertising, attract more members to its subscription service. But it also launched a new grocery brand called Better Goods with most items under $5, including meal solutions like frozen pizzas and chicken wings. Now, why does this matter? Because we saw earlier in another video where McDonald's continues to see the consumer trading down and trading out of, more importantly, trading out of McDonald's, not going out to eat as often. And this is what we're seeing here. The CFO, Rainey, said Walmart is likely benefiting as consumers look for cheaper alternatives to fast food. Now, when we're all looking for cheaper alternatives to fast food, that's not a good sign for the economy. We're all getting more cautious. And I think we should be cautious, right? None of us know if a recession is coming or not. Rainey goes on to say he referred to inflation data which came out this week and showed that the gap in prices between food at home and food away from home continues to grow. It stands to reason that customers are shifting to prepare more meals at home versus eating out. So that was one of the dynamics that he saw. People saying we can no longer afford to eat out anymore, right? At first, people were trading down from more expensive restaurants to the fast food restaurants to McDonald's. And now they're trading away from McDonald's and choosing instead to eat at home, which frankly is probably healthier for all of us. But it's not good news for the economy. And then I also want to share that Walmart's customers in the US, they visited the company's stores and website more, and they spent slightly more than they did during the quarter the year prior. But look at these numbers. Transactions rose just 3.6% and average ticket price was up just 0.6% compared to the year ago quarter. Well, inflation was more than 0.6 over the prior year. So essentially, people are buying less and they're trading down on brands at Walmart as well. I know a lot of us are doing that. Many of us, since the pandemic, the brand name food products that we used to buy have gone so much more expensive that many of us have tried the store brands. And you know what? We found out some of them are pretty good. Others suck, but some of them are pretty good. And so we've traded down to those, and we're probably not going back to those brands. So what's happening with the consumer? And more importantly, what should we be doing? I think all of these reports are showing that the consumer continues to slow down. We've seen that unemployment has risen. We're all feeling less secure about our jobs, and that causes us, rightfully so, to be cautious about our spending and to try to save as much as we can in case there's a rainy day coming in the future. So I think that the consumer continues to tell us that the likelihood of a recession is probably much higher than what many of the pundits on television are telling us. A recent survey of professional money managers indicated that money managers are only giving the likelihood of a recession an 11% likelihood of happening. And I think that's dramatically lower than what it should be. And I'm not alone. The CEO of JP Morgan Chase, a gentleman by the name of Jamie Dimon, feels that the likelihood of a recession is closer to 25% to the mid-30s. And I'm in that ballpark as well. Do I think a recession's coming? I don't know. Do I think it's coming in 2024? I don't know. Is a recession coming? Yes, a recession, unfortunately, is coming because a recession is always coming, whether it's in 3 months, 3 years, or 10 years. The challenge is we don't know when that recession is coming. So what should we do as consumers? What should we do as investors? As consumers, I think we should always try to spend less than what we earn. We should try to save. We should try to invest that money wisely and just build for a stronger future. And one way to do that is every time we get a raise, every time we get a promotion, half of that goes to current us and half of that goes to our future self so that we can build up that retirement security, that emergency fund, the nest egg for our kids' college expenses, whatever we're saving for, to build that up. So that's job number one. But what about on the investment side? Should we change our investments? And for most of us, the answer, this is not financial advice for anybody, but most of us, the answer is have a long-term asset allocation. We cannot predict when a recession is going to happen. We cannot predict when the stock market is going to crash. So it's more about time in the market than trying to time the market. It's about making good decisions. And when we look at a stock chart, they tend to go from lower left to upper right. And so the best decision for most of us, given that we cannot time the market, is to come up with an asset allocation that makes sense for who we are in the market. I encourage you to work with a fiduciary financial advisor or an accountant to come up with a game plan that makes sense for you and to make the best decision that's right for you. And speaking of making the best decision, that's why I made this video up here, which talks about why retiring at 65 might be a big mistake for many of us. Thanks for watching this video, and I'll see you in the next one. Bye-bye.